Welcome. Today we're going to talk about the first two statements we need to prepare. That's the income statement and the statement of retained earnings. Now both of these statements, you'll notice, are for the month ended. So they cover a period of time. When we look at the balance sheet, we'll see that that's would be just a day in time. So it'd be like June 30th, 2014, or whatever year it happens to be. When we do financial statements, we always want to title it the name of the company, the name of the statement, and the period of time or day and time that is on that statement. We also want to group things. So we will group all the revenues together. Now these red lines just indicate the column lines. They are not really on the statement. They're just there so that you can see that there's a column. So the revenues, first thing we look at is sales. First item in a column needs a dollar sign, so it has a dollar sign there. Service income, second item in the column does not need a dollar sign, although you can put it there. So we usually group our revenues from biggest to smallest, but you can do it however you want to. So sales were $1,000, service income was $800. We draw a line, that means I'm going to make a total, and so we bring that out to the total column. So this column here is a subtotal column, this is a total column. So the total revenue then is $1,800 in the total column. First line in a column needs a dollar sign. Expenses. There are a lot of ways of grouping expenses. Could be alphabetical, could be by account number, and it could be by dollar amount. But we always put miscellaneous last. So you see here I got rent, utility expense, and miscellaneous expense. $600 with a dollar sign by rent expense. Then again, that's the first item in a column. Anytime you have a line somewhere up above, the next number below that line is essentially a new column. So $600 for rent expense, then utility expense. Miscellaneous expense was $200. Again, what does the word miscellaneous mean? It means whatever is not above. So that's all expenses that are not rent or utilities. Then we draw a line. That means we're going to total the expenses. We bring that out to the total column. Since there's an item above it, does not need a dollar sign, although it's okay to put a dollar sign there if you want. That's fine. And then we draw a line, and we're going to do the difference, which is net income. In this case, $1,800 minus $1,200 is $600. Could be a net loss if revenues were less than expenses. So again, it would be a net loss if revenues, say, were $800, expenses $12. You would have a loss. So here, net income, $600, needs a dollar sign because it's first item below a line. And then two lines to indicate that that's the end of the statement. Now, I'm not going to hold you with regards to dollar signs, lines, and titles on a test, but the idea here of telling you is so that you have some degree of knowledge as to how it's done in real life. Now you notice that $600 net income comes over to the statement of retained earnings. So we got a company, statement of retained earnings, again the name of the company, the name of the statement, and for the month ended June 30th. We got retained earnings. Generally it's dated, so we'd say June, in parentheses, June 1st, 2014. I didn't have room to write all that. Dollar sign in 2000. Now if it had been zero, that might have meant that the company just got started. But since there's a dollar amount there, that means the company has been in business for a period of time and some money has been left in the business. So we take this 600, put it in the subtotal column. Again, subtotal columns are to the left, totals are to the right. We add the net income. That income came from the income statement, so it comes all the way up here, $600 with a dollar sign, less the dividends. Now, dividend is a return of the owner's capital, or it could be a return of net income to the owners. it is something that they receive back. So that income is not left in the business. The amount of income that's left in the business is this increase or possibly a decrease in retained earnings, which is the difference between the $600 and $400. So we draw a line here, increase in retained earnings $200. The income was $600 again. The dividends paid to the owners was $400. So $200 was left in the business to do things to help make a bigger profit in the future. Now that could be any place. It's not necessarily in cash. That can be any place. So that was $200 increase in retained earnings. So $2,000 plus $200, we draw a line here, will be the ending retained earnings, again, dated June 30th, 2014. $2,200 in this case, with a dollar sign being the first item below a line, and then two lines to indicate the end of the statement. Again, I'm not going to hold you to lines and dollar signs and all that, but I want you to understand how a professional does it so it makes it easier for you when you're doing it. Again, when you're doing statements, subtotals always go to the left, totals always go to the right. So a quick review, I know it's a little bit long here. Name of the company, name of the statement, and the period of time covered. Group things like revenues, expenses, together, bring totals out to the total column, and any difference, you have a line and you take a difference, in this case net. Net means a difference, and so net income $600. The income statement obviously has to be produced first, because that net income or loss goes over to the statement of retained earnings. So retained earnings always has a beginning date and an ending date. We add the net income, we would deduct the net loss, and we deduct dividends. If the income's bigger than the dividends, we have an increase in retained earnings. If there's a loss or the dividends exceed the income, we could have a decrease in retained earnings. That'll give us our ending retained earnings balance, which is this plus or minus that, to give us this dollar amount here. Retained earnings could conceivably be negative, especially for a startup company. So I hope this helps you understand why the income statement is produced first, because then the amount of net income or loss goes over to the statement of retained earnings. The ending retained earnings will also go someplace. It will go to the balance sheet. So the statement of retained earnings has to be produced second, and the balance sheet, which will be on another video, will be done third. So look forward to seeing you on the next video. Take care and have a good day.